Picture this. It's October 1929. You wake up, grab the morning newspaper, and the headline screams in bold, "Stock market crashes. Billions wiped out." Overnight, life savings are gone. Men in Wall Street suits stand silently on sidewalks, staring into nothing. Banks are shutting their doors. Families are lining up for bread, not dividends. This wasn't just a market dip. It was the beginning of a storm so devastating that it reshaped not only America, but the entire world. They called it the Great Depression. And while it happened nearly a century ago, its lessons are more urgent than ever, because history may not repeat word for word, but it loves to rhyme. Fast forward to today. Inflation eating into your groceries, rising interest rates shaking up the housing market, stock indexes swinging like roller coasters, and in the background, quiet whispers, are we heading toward another Great Depression? Here's the reality. Every boom feels unstoppable, until it isn't. And when crashes come, the people who survive aren't the loudest traders or the riskiest gamblers. They're the ones who prepared, who studied history, who recognized the signals. So let's ask the question that matters most. What can today's investors learn from the worst financial disaster of the 20th century? The 1920s were electric. Jazz was blasting, skyscrapers were rising, cars were rolling off Ford's assembly lines. And the stock market? It was a rocket ship. Everyone was investing. Businessmen, teachers, even shoe shiners. Stocks weren't just investments, they were a ticket to the American dream. But beneath the glitter was a dangerous foundation: speculation. Investors weren't buying companies, they were buying dreams. And worst of all, they were buying those dreams on borrowed money. On Black Thursday, October 24th, panic hit. Within days, billions of dollars evaporated. By 1932, the Dow Jones had lost nearly 90% of its value. Imagine buying at $100 and watching it sink to $10. Banks failed, people lost homes, unemployment hit 25%. Families that once dreamed of prosperity now fought for survival. And yet, even in this chaos, lessons were carved into history. Lessons that, if applied today, can protect us from making the same mistakes.
Lesson 1. Watch the macro trends. The Federal Reserve raised interest rates in the late 1920s to curb inflation. That single move tightened credit, slowed borrowing, and helped trigger the crash. Lesson: markets don't move in isolation. Ignore macroeconomics at your peril. Today's parallel? Central banks still control the levers of the economy. Interest rate hikes, quantitative easing, inflation reports. These shape the battlefield more than anyone's stock tip on Twitter. Smart investors track the big picture, not just the noise. Lesson 2. Avoid margin investing. In the 1920s, people bought stocks on margin, essentially borrowing money to invest. The problem? When stocks fell, brokers demanded repayment. Millions got wiped out, not just by losses, but by debt. Lesson? Leverage is a double-edged sword. It multiplies gains, but it can destroy you faster than anything else. Today's parallel. With easy online trading, margin is just a click away. But one unexpected crash, like the 2020 pandemic drop or a sudden crypto collapse, and leveraged traders are left holding empty accounts. Lesson 3. Diversify wisely. When the market collapsed, speculative stocks, especially in railroads and construction, vanished. But companies producing essentials, like food and electricity, endured. Lesson? Diversification isn't about owning 50 random stocks. It's about owning uncorrelated assets, staples, utilities, sectors that survive even when optimism dies. Today's parallel? Whether it's global ETFs, bonds, gold, or even cash reserves, real diversification is your parachute. Lesson 4. Cash is a position. In the depths of the Depression, those with cash weren't helpless. They were hunters. They bought farms, businesses, even real estate for pennies. Lesson? Sometimes the smartest move is not to play every hand. Cash gives you options when panic strips others of theirs. Today's parallel? Sitting on liquidity may feel boring, but when markets drop, the patient investor becomes the predator. Lesson 5. Emotional discipline wins. Perhaps the hardest lesson of all. Fear ruled the 1930s. People swore never to invest again. Many missed out on the eventual recovery because they couldn't overcome the trauma. Lesson? Your worst enemy in investing isn't the market, it's your own fear and greed. Today's parallel? Every dip sparks panic selling. Every rally sparks reckless FOMO. But the investors who win long-term are those who keep their heads cool while everyone else loses theirs. The Great Depression wasn't just a historical tragedy, it was a brutal teacher. It taught that markets can fall harder and longer than anyone expects, that governments can miscalculate, that greed can blind even the smartest investors. But it also taught that resilience, discipline, and preparation pay off. So the real message: you don't have to fear history, you just have to learn from it. Because while another 1929 may not happen the same way, bubbles, crashes, and panics are part of the cycle. And those who study the past will always have an edge over those who ignore it. If the Great Depression shaped one generation of investors, the next great transformation came with World War II, a conflict that rewired global finance and set the stage for today's superpowers. That's our next episode. So subscribe, hit the bell, and let history guide your future. Because knowledge isn't just power, it's profit.